For more on the move today, let's welcome in now Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always great to see you and have you on the show. Maybe start, Steve, listen, it's the mover of the day. It's Tesla. It's ripping higher. What do you make of the move, Steve? More broadly, what are the ripple effects, do you think, the lessons learned for the market here?
Hi, Josh. Well, basically, this is a hard story to poke holes in, and you really can't, which is why the stock is up 20%. And yet again, though, it was not as much that they beat on their current EPS, which is of course very important, but it's that the guidance was really terrific, and they beat in the right ways. Margins expanding, talk of higher sales going forward, double-digit higher sales in the next year. We'll see if that's achievable, but the market—that's what the market wants to hear. And you know, as you played in the Dan Ives clip, there definitely was a lot of bearishness, some skepticism that I noted in the options trading going into this. A lot of times when the options market's a little bit nervous and sketchy, that's when the opposite happens.
You know, I think Tesla's a good example, though, that not all Mag 7 stocks are created equal. I mean, not just because Tesla's been the laggard this year, but because more when you get an Alphabet or Microsoft, maybe you see the rest of the market taking more cues, perhaps. How do you think the rest of the market kind of looks at Tesla?
Tesla's a bit of an outlier at this point. For a while it wasn't, because Tesla had the number one share of the market's mentality, the market psychology. That was probably I broke the history of Tesla up a couple of weeks ago into B, T, and AX, before Twitter and after X. In the before Twitter era, it was the company. And that was it. And it deserved to be. It was up like 20-fold in about 2 years or 3 years or something of that nature. It ought to be. It was NVIDIA on steroids in terms of performance. But since then, it's really, people have started to value it a little more carefully, whether it's because of the Twitter acquisition or whether it's just because of maturation. But as a result, you know what? When you think about it, there's a lot of overlaps between the other stocks. NVIDIA's customers are the other Mag 7 stocks for the most part. You know, Alphabet and Microsoft overlap in many ways. Google and Apple both make phones. So there's a lot more interconnectedness, whether it's more from a competitive basis, but they're sort of all in the same turf there, and Tesla's really not.
Let me ask you a broader question. You said recently something interesting. You said, listen, surfing the wave right now has been working for a lot of folks. Hopefully, you said, it doesn't end in a wipeout. How could it end in a wipeout? I mean, what is on this sort of Steve Sosnick wall of worry?
Well, I mean, I guess, as my life spent as a risk manager, really, that's unfortunately a skill I've honed for years. But what it means is it's often something you don't expect. The geopolitics, we all know what's out there, and quite frankly, we sort of have a sense of what can happen. Yes, I mean, if things really metastasize, and I have a feeling that Israel's hanging out until after the election right now. But that, the Middle East can always flare up, and I hope it doesn't. The election itself can be a bit of a hairy situation. I think right now, although the market sort of has been pricing in some Trump trades, I think the polls are still telling you that it's a coin toss. And, one of the reactions might be, basically the bond market may flip out, if Trump seems to be going through with the idea of his tax policies. On the other hand, if Harris seems committed to not extending the Trump tax cuts, you may see a little of tax selling brought forward rather than kept into next year. So that could be a potential risk too. And then of course there's just the lofty expectations. We've priced in 15% growth for next year, basically, on earnings, and that's a tough thing to reconcile with an economy that's people are clamoring for interest rate cuts. Considering though that the Atlanta Fed's GDP now is 3.4%, something's got to give.
And the economic data we saw today, Steve, I mean,
very strong.
New home sales, initial jobless claims, yeah.
So are you going to get rate cuts in that environment? Yeah, you'll probably get 25 at the next meeting because it's kind of baked in. But going forward, how much are they going to do? And so the markets better figure out. It better lean on the side of the strong economy that can deliver those earnings results rather than sort of hinging upon rate cuts. And if we're hinged too much upon rate cuts, that could be a bit of a disappointment as well.
I'm curious, Steve, what you make of the idea. I'm reading Josh Brown's recent book, and one of the things he's talked about for a while is that there is sort of this vested interest in the market going higher. I mean, that much is obvious. But that it is held by more and more people. In other words, people rely on it for retirement, not depending on Social Security. And so there's this, huge passive income in the market, but also a lot of people like us, right? People like working people in the United States who are buying stocks because they want something to retire on. And that there is that floor under the market that is going to just continue to keep it up. You look skeptical.
Yes, because the problem becomes if everybody starts to worship at the same altar. There's no, it gets too crowded. So if everybody starts to be fully invested in stocks, who's left? Who's the marginal buyer? That's the scary part to me sometimes. But you're right. I mean, you know what? We all should want it to go up. I mean, and it's interesting what happens in terms of my phone calls. On a day like yesterday when we were down, call it 1% on S&P, my phone's buzzing constantly. Why are we down? Why are we down? I don't get any calls when we're up a similar amount because it's supposed to do that. So, and especially in a bull market right now, it does do that much more often. So something seems wrong when we go down, even if that's just normal volatility. I've used the term socially acceptable volatility versus plain old real volatility, but they're the same thing. That's just moving up and down. But we all want it to move up. We all want it to move up. Everybody does. This whole ecosystem is built upon it going up. And so, I think that's why it's helpful to have market-friendly policies all the time, especially as more people, as you say, have come to rely on the stock market as a source of wealth. On the plus side, also, it's created a wealth effect because everybody people feel better when they look at their 401k and it's a bigger number.
They do, and maybe they're more willing to spend. Exactly. Thanks a lot.